How the stock exchange works. Think of the stock exchange as a giant marketplace. But instead of people buying fruit, cars, or clothes, they are buying and selling pieces of businesses. Now, if a company wants to raise money, instead of borrowing from a bank, it decides to sell tiny ownership pieces of itself to the public. Those ownership pieces are called shares. The company lists those shares on a stock exchange. Now investors from all over the world can buy them. So, what happens when you decide to invest? You open a brokerage app. You search for a company you want to own. You enter how many shares you want to buy. Then you press the buy button. Note that you are usually not buying those shares from the company. You are buying them from another investor who has decided to sell. The stock exchange simply matches the buyer with the seller. Think of it like an online marketplace. One person wants to sell. Another person wants to buy. The marketplace connects them and makes sure the transaction happens safely. That's exactly what a stock exchange does. Now, what decides the price? Let's say a company has 1 million shares available. Suddenly, millions of people want to buy them because the company is growing fast. There are more buyers than sellers. The price goes up. Now imagine the opposite. The company reports disappointing results. Investors lose confidence and start selling. There are more sellers than buyers. The price goes down. Notice something. The stock exchange doesn't decide the price. The buyers and sellers do. Every second the market is open, thousands of people are placing buy and sell orders. The stock exchange simply keeps matching those orders, and the price keeps changing throughout the day. Now let's follow one complete transaction. You decide to buy one share for $100. Your broker sends your order to the stock exchange. At that exact moment, someone else is willing to sell one share for $100. The exchange matches both orders. The seller receives your $100. You receive the share. The stock exchange has done its job. Now you own part of that company. Tomorrow another investor may think that same share is worth $110. If you decide to sell, the exchange matches your share with that new buyer. You receive $110. The new investor receives the share. That is how money changes hands in the stock market. The exchange itself isn't buying or selling stocks. It simply provides a secure place where millions of investors can trade with each other. Without a stock exchange, finding someone willing to buy or sell your shares would be incredibly difficult. It's like trying to sell your car without using a dealership or an online marketplace. You would have to find a buyer yourself. The stock exchange solves that problem by bringing everyone together in one place. So when you hear people say, the market went up today, what they really mean is that, on average, investors were willing to pay higher prices for stocks than they were yesterday. And when the market falls, it simply means more people were selling than buying, pushing prices lower. The stock exchange is a marketplace where ownership in businesses changes hands every second. Every trade follows the same simple process: a buyer wants to buy, a seller wants to sell, and the stock exchange connects the two.